I'm Susan McGinnis in the Energy News Center. Oil prices topped $86 a barrel today on a falling dollar and some promising reports about the economy. Also, a report on natural gas inventories shows that stockpiles jumped more than analysts predicted. That sent prices lower. Joining us now for some more perspective on the week's inventory reports in these markets is Elliott, editor of the Energy Letter and the Energy Strategist. Elliott, thanks for coming in.
Thanks for having me.
So we have oil headed for its second weekly gain on a weak dollar. And do you agree we're seeing several signs of a rebounding economy in the U.S.?
I think we are. We've pretty consistent data that has been positive over the last couple of months. Retail sales, consumer spending, ISM data. The manufacturing economy seems to be bouncing back even more quickly than expected. And we're actually seeing direct signs of a year-over-year increase in oil demand.
Okay. We also have refineries raising operating rates. What kind of a sign is that?
It's a sign that maybe they feel that this summer's driving season is going to be pretty decent, at least compared to last year's. And I think that makes a lot of sense. You're seeing consumer spending really tick up on all sorts of items, pretty much across the board. Yeah. And that's a sign that probably consumers are going to travel a little bit more this summer than they have.
So we have crude prices bobbling between 70 and 85 for something like 9 months until earlier just this week they spurted higher. Are we seeing a solid move upward? Because now we have analysts talking about the triple digits.
Yes, I think we are. I mean, basically what we saw on the chart of oil was sort of a trading range, as you mentioned, between about 70 or the upper 60s and $83, $84. Whenever you have that kind of a range that's tested for a long period of time and you break above the top of that range, the market tends to get a little bit of momentum going. And we've definitely seen that. Prices broke above that sort of $83.50 area and zoomed right up to $87. I think you'll probably see $90 oil this month, and I would not be surprised at all to see $100 oil touched at least at some point this year.
Wow. So where does that leave the investment opportunities?
Well, it's pretty broad-based across the sort of oilier stocks, both on the services names and also on the producing side. One thing on the services side is we've seen several $1 billion worth of projects restarted in the Middle East. A lot of these projects were delayed back during the financial crisis due to low commodity prices and also just a lack of funding. And a lot of those projects are being restarted in places like Saudi Arabia. Obviously, Iraq is another area that's ramping up.
So we want to look at U.S. companies involved in those Middle East projects?
That would be sort of the top place I would look, because the services companies are more leveraged to oil upside than a lot of people want to buy a big company like ExxonMobil or Chevron. Those companies actually tend to underperform in a rising oil price environment. They're seen as more defensive names. They have a lot of refining exposure. Instead, look at a company like a Schlumberger or a Weatherford. These are the companies that are going to benefit most. In fact, both those companies just got a contract on the Rumaila oil field in Iraq from BP, probably about a $500 million contract.
Okay, let's move on to natural gas, because we had stockpiles gaining in this area, and that brought down prices earlier this week after that inventory report. Were you surprised? Now we have inventories 12% above that 5-year average.
We're seeing a lot of it is driven by weather. We saw a much colder than normal winter, and that normalized natural gas inventory. I think at one point they were actually slightly under the 5-year average. We've seen a much warmer than normal sort of March, April period, and that's really driving lower than normal gas demand and faster than normal builds in inventories.
So it looks like we're seeing supply increasing at a time when the demand is just not there, and including on the industrial side?
I think the industrial side will probably bounce back with the economy. If we're going to see a recovery in oil demand with the economy, I think we should see a recovery in industrial demand for natural gas. In fact, I think you'll see quite a bit of natural gas substitution this year. Basically, anywhere that you can substitute natural gas for oil, you're going to do it right now, given the huge price differential between those two fuels.
So the increase in the rig count doesn't bother you then? It's not. You don't think it's going to lead to excess supply that isn't needed?
It's a very interesting point, because one of the sort of persistent arguments of those that have been kind of bearish on natural gas has been that U.S. natural gas supply is increasing, even though the rig count is still down from where it was in August of 2008. But as the EIA actually came out earlier this week and announced that they believe that their data on production is flawed, and it's been actually overestimating U.S. natural gas production. The main reason for that is they're using a model that was developed when shale gas wasn't as important as it is today. So they've been sort of overestimating. They've been surveying the largest producers, and then using that to extrapolate what the smaller producers are doing in terms of production.
You would think that would lead to underestimating, since the shale has been found to lead to such abundant resources.
Well, but mainly the larger natural gas producers are the ones involved in the shale, and they're using the data from those producers, which shows quite strong production, to estimate production from the smaller producers who really aren't involved in the shale. They're more involved in conventional. And if you look at, there's an error term in each monthly natural gas report that shows how the numbers don't quite match up. And those numbers have been growing, which indicates a pretty significant overestimation of supply.
Okay, just quickly, the investment outlook for natural gas companies.
I think we've probably seen a bottom in most natural gas companies. They're still trading well off where they were at the end of last year. And I think that you want to look at producers which have a nice position in the shale, and you want to look at services companies with some tie to U.S. natural gas, names like Baker Hughes, which just bought BJ Services, or names like Neighbors, which is a driller which has a lot of the horizontal rigs that are used for unconventional gas production.
Okay, we'll look into those. Elliott from the Energy Strategist and Energy Letter, thank you.
Thanks for having me.
And we appreciate it. And I'm Susan McGinnis. You're watching Clean Skies News.